Welcome back to the deep dive. Imagine just for a second you're standing right there about to buy your first home. That feeling, excitement, sure, but also maybe just a bit of sheer financial terror.
Oh, absolutely. The deposit, the mortgage,
Exactly. Decades of commitment stretching out, it kind of defines your future.
it really does.
Now scale that feeling way, way up.
Hmm.
Think about a huge global corporation meeting a brand new multi-million-dollar factory. Or maybe a whole fleet of, I don't know, cutting-edge self-driving trucks.
The stakes are just immense at that level.
Right. For them, these aren't just, big financial choices. They're really strategic maneuvers. Things that could genuinely make or break their entire future.
And the core dilemma often seems quite simple on the surface, doesn't it?
It does. Do they take on that huge burden of owning it outright? Or maybe is there a smarter way, a more flexible path?
Mm.
Today, we're pulling back the curtain on exactly the whole world of leases. We're not just going to dive into some uh, dry accounting rule book here.
No, definitely not.
We're dissecting a really fundamental business decision, one with truly profound financial implications for a company's health, its future. We're talking about how businesses get those critical assets,
Yeah.
what we often call non-current assets in finance.
The big stuff. Property, plant, equipment.
Yeah, the big ticket items, things a company plans to use for, well, more than a year.
Mm.
Factories, production lines, maybe even just their main office building. Okay, let's unpack this. Today, we're taking a deep dive into the world of leases.
And what's truly fascinating here, I think, beyond just the technical rules, is how these seemingly straightforward choices, buy versus lease, how they can actually ripple through a company's entire financial story.
Right.
It's not just about the cash leaving the bank today. It hits their balance sheet. It influences how investors and lenders see them. And really critically, it affects their strategic flexibility, how nimble they can be in a market that's always changing.
So important.
We're going to really explore the why behind the financial reporting for these deals, not just the what.
That really is the core of it, isn't it? So our mission for you, our listener, is pretty clear today. By the end of this deep dive, you'll not only get this strategic thinking that pushes companies towards leasing,
Mm-hmm.
but you'll also really grasp the precise definition of what a lease actually is, and crucially, how these deals are recognized, how they're measured, and how they're presented in a company's financial statements.
And we're focusing specifically on the lessee side, right? The company actually using the asset.
Exactly. We're looking at it from the perspective of the entity using the asset, the lessee. It's sort of a shortcut to being really well informed about this absolutely critical bit of business finance.
Okay.
But, to really get the accounting, I think we have to start with the business decision itself. So let's kick off right there, the fundamental strategic choice. Okay, so when we think about those really large non-current assets, the big expensive stuff like a huge factory complex or maybe a really specialized bit of industrial machinery, the whole idea of buying them outright,
Mm-hmm.
well, it can be incredibly daunting for any business, can it?
Oh, absolutely. It's like that house purchase example, but just magnified massively, industrial scale, sometimes global scale. The stakes are just exponentially higher. Hashtag tagged, hashtag 1.1, the heavy burden of outright purchase. And you've hit the nail on the head there. Many companies, maybe most, simply don't have that kind of immediate liquid cash just sitting around to buy these incredibly expensive assets outright.
Right. That's a huge chunk of change.
Imagine say, a manufacturing firm that's doing really well, demand is surging, great problem to have, right? But to capitalize, they urgently need a new factory, maybe a state-of-the-art production line.
Yeah.
The sheer amount of capital needed to just buy that could completely cripple their liquid cash. It could drain their working capital down to, frankly, dangerous levels.
Leaving them really vulnerable.
Exactly, vulnerable to unexpected costs, market dips, anything. So it's not just about funding growth. Sometimes it's about basic financial stability, even survival.
And if they don't have that cash just lying around, what's the next logical step? They pretty much have to look at external financing, don't they? Taking on debt.
Precisely. When the senior management team, the SMT, decides, okay, the strategic need for this asset outweighs the upfront cost, they almost always have to resort to taking out significant loans, often long-term loans.
Oh.
But it's not just about having that debt on the books, which is obviously a major commitment in itself. A really key condition for these big loans is usually that the company has to pledge the very asset they're buying as security, as collateral.
Okay, so the bank essentially has a claim on the asset if things go wrong.
Exactly. And that requirement directly increases the company's debt profile on its balance sheet, which in turn can have serious downstream effects. It can impact their credit rating, make future borrowing more expensive, maybe even harder to get. It can definitely restrict their strategic options down the line.
Okay, so let's say an SMT does go down that road. They decide to buy a new factory using a hefty loan. How does that actually show up on their financial statements? What's the immediate visible impact for someone reading those reports?
Right. On the financial statements themselves, the picture is pretty clear. The factory, or the equipment, whatever it is, gets recognized as a non-current asset, shows up on the statement of financial position, the balance sheet. It's something the company owns and controls long term.
Makes sense.
At the same time, the loan they used to buy it appears as a corresponding non-current liability. Also, on the statement of financial position, reflecting that long-term rent they now owe.
Asset and liability matching up.
Exactly. And then there's the ongoing cost. The interest payments they make on that loan, the cost of borrowing the money that gets recorded as a finance cost in the statement of profit or loss. And that directly reduces their reported profit for the period.
So it hits the bottom line.
It absolutely does.
Yeah.
So yes, they gain a valuable asset, but they also take on significant debt and this ongoing expense that eats into their profits. It's very much a double-edged sword.
That really spells out the financial responsibilities of buying.
Huh.
It's a heavy, long-term commitment, shapes the company's whole financial structure. But what if a company wants to stay, lighter on its feet, more agile, especially in industries where, let's face it, technology changes incredibly fast? Obsolescence is a real threat. That's where the alternative leasing really starts to look attractive, doesn't it? Offering benefits that go way beyond just spreading out the payments.
Absolutely. Beyond simply spreading those payments and easing the immediate cash flow pain, which is, let's be honest, a huge draw, leasing tackles an even more critical strategic issue, especially for certain types of assets. And that issue is technological obsolescence.
Yeah.
Think about specialized plant and equipment, or even more so, rapidly evolving IT infrastructure. If a company sinks a huge amount of capital into buying that kind of asset, they run a very real, very significant risk of being stuck with outdated tech much sooner than they'd like.
Yeah, I can totally see that. It's like buying the absolute top-of-the-line computer today, and then 18 months later, maybe even less, something vastly faster and more efficient comes out.
Exactly. And for a business, that kind of obsolescence isn't just, a minor annoyance. It's a direct hit to their competitive edge, to their bottom line. It's potentially a very costly mistake.
So how does leasing help there?
Well, that's precisely where leasing can be such a powerful strategic tool. It essentially provides a built-in exit strategy for assets that are likely to become outdated quickly.
Okay.
An SMT can structure a lease agreement to use the asset for a specific defined period, maybe 3 to 5 years, whatever aligns with its expected peak efficiency lifespan. And then at the end of that term, they can simply return it.
And presumably get the latest model.
Exactly. They replace it with a brand new cutting-edge version. They aren't left holding the bag, trying to sell off an obsolete asset, taking big depreciation hits, or worse, having their operations held back by using inferior technology.
So let's push that a bit further. Why would a company in, say, a really high-tech sector, maybe a cutting-edge software development firm, or perhaps a specialized biotech research company, why would they almost always prefer leasing over buying for things like their super high-end research gear or those massive server farms they need? It feels like it would almost be fundamental to how they operate.
Oh, for those kinds of sectors, it's often way more than just a financial calculation. It's about survival, about staying competitive, about innovation.
Right.
Leasing fundamentally reduces that risk of holding obsolete assets. It lets them keep that crucial competitive edge by ensuring they always have access to the very latest technology. And they can do that without the massive upfront capital spend that could stifle innovation in other areas. And without that long-term ownership commitment, it keeps them incredibly nimble.
Nimble is key in those industries.
Absolutely. Think about that software company needing incredibly powerful servers for, complex AI modeling or massive data processing, those systems. They're likely to be significantly superseded by newer, faster, more efficient models within just, say, 3 to 5 years, maybe even faster.
Moore's Law in action.
Pretty much. Leasing gives them the agility to upgrade quickly, efficiently. It ensures their infrastructure always supports their innovation pipeline and keeps them right at the forefront. It's really a strategic investment in continuous modernization.
That flexibility sounds like an incredibly powerful driver for so many businesses, especially those in fast-moving, capital-hungry fields. But this leads us to the next question. We've talked a lot about the why. But what exactly is a lease when you look at it through the very precise lens of financial reporting? There must be a specific definition that drives all the accounting treatment.
There absolutely is, and nailing that definition is key.
Okay, so we've really dug into the strategic side, the why companies choose to lease. But, for financial reporting, a general understanding just isn't enough, is it? We need something precise, something unambiguous that every company follows. So, from that really strict accounting viewpoint, what exactly is a lease? Hashtag 2.1. What exactly is a lease? A contractual right to use.
Right. From the financial reporting standard itself, IFRS 16, the formal definition of a lease is a contract or part of a contract that conveys the right to use an asset for some time in exchange for consideration.
Okay, that sounds, well, a bit formal, maybe a bit legalistic.
It is a bit of a mouthful, I grant you, but honestly, every single phrase in that definition unlocks a really crucial piece of how we actually account for these arrangements.
All right, let's pull it apart then for everyone listening. What are the absolute key elements in there that we really need to zoom in on?
Okay, first off, it's a contract. That immediately tells you it's a formal, legally binding agreement, not just some casual understanding.
Got it. Formal agreement.
Second, and this is really important, it conveys the right to use an asset. Notice, it's specifically not ownership.
Ah, the right to use versus actual ownership. That sounds critical.
It's absolutely vital. You're gaining operational control, you get the benefits from the asset for a specific time, but you don't actually get the legal title. Third, there's a defined period, what we call the lease term. The arrangement has a clear start and a clear end date.
Yeah, so it's time-bound.
Exactly. And finally, there's consideration, which basically means there are specific agreed-upon payments being made in return for getting that right to use the asset.
Payments. Money changing hands.
Usually money, yes, or something else of value. But without all four of those elements, contract, right to use, defined period, consideration, it wouldn't technically qualify as a lease under the IFRS 16 standard.
Okay, that's much clearer when you break it down like that. So we're talking about actual payments for that right to use. Can you give us a couple of concrete, real-world examples of what these lease deals look like for businesses?
Sure. A classic one is a property lease. A business might sign a contract giving them the right to occupy an office building or maybe a retail shop for, let's say, 20 years.
Long term.
Often, yes. And that contract would typically require them to pay an initial deposit upfront when they sign and then follow that with regular payments, maybe monthly, maybe quarterly, could even be every 6 months.
Okay. What about things other than property?
Well, think about a company leasing specialized machinery, plant, and equipment. The contract there is probably going to be for a shorter term, maybe 3 to 7 years perhaps, but it'll have very similar clauses covering that right to use the specific equipment and the schedule of payments. These aren't just simple rental agreements, they are structured financial arrangements.
That distinction you made earlier between the right to use and actual ownership, that feels really fundamental. It also makes me wonder about the nitty-gritty of the payments. Does it actually matter for accounting purposes if a company pays its lease installment, say, at the beginning of the month versus the end of the month, upfront versus afterward?
Oh, it makes a huge difference. That timing, whether payments are made in advance or in arrears, it becomes an absolutely critical detail when we get into the mechanics of the financial reporting. We'll definitely unpack that.
Okay, good to know.
But for now, for you, the listener, just internalizing this full definition is really the foundational first step. It makes it clear that a lease, for accounting, is much more than just renting something casually. It's a legally binding financial deal with very specific features that have major implications for how a company looks on paper. It's really key to understanding how these things get reported.
Understood. So we have that precise definition now. Where do we focus our attention when we actually look at the financial reporting side? Are we looking at both the company providing the asset and the company using it?
That's a great question about scope. For what we're covering in this deep dive, and this aligns specifically with how it's often tested, say in the CIMA F1 syllabus under section B2B, the focus is really squarely on the lessee.
The lessee, that's the company using the asset, right?
Exactly. The entity that obtains the right to use the asset. We're deliberately not going into the complexities of the lessor's accounting. That's the legal owner who's providing the right to use. We'll keep that separate for now. Okay. This simplifies things for our current discussion, but it also really underscores how important the user's perspective is in modern financial reporting. It's all about how your company accounts for using an asset that technically belongs to someone else.
That's a really important focus. So for our listener then, What does this actually mean practically in terms of what they need to be able to do from a financial reporting point of view? What are the key actions?
Okay, so for you, as someone wanting to really understand this, it means being able to do three key things. First, you need to be able to spot when a contract actually contains a lease based on that precise definition we just hammered out.
Huh.
Sometimes you have to read contracts pretty carefully to see the underlying substance.
Okay, spot the lease. What's second?
Second, you need to be able to confidently figure out the correct lease term. How long is this arrangement really expected to last? Because that period dictates how you account for it over time.
Right, the duration. And third,
Third, and this is really the big one, the cornerstone of modern lease accounting under IFRS 16. You need to recognize both a right-of-use asset, which represents the benefit, what the company gains, that's a debit entry, and a corresponding lease liability, representing the obligation, what the company owes, that's a credit entry. And you recognize both of these right at the lease commencement date.
a right-of-use asset and a lease liability, both hitting the balance sheet at the same time.
Precisely. This dual recognition is fundamental.
And just to be super clear, what exactly is that commencement date? When does this recognition actually happen?
Good clarification. The commencement date is specifically defined. It's the date when the underlying asset is actually made available for use by the lessee.
Not when the contract is signed necessarily.
Not necessarily. It's when they physically get control, when they can actually start using it and getting economic benefits from it. And look, this isn't just some, academic box-ticking exercise.
No.
No. Recognizing both the asset and the liability is all about accurately reflecting the true economic substance of the deal on the company's balance sheet. It's absolutely vital for achieving what we call faithful representation, making sure the financial statements give a true and fair view of the company's real financial position. It's all about transparency.
That makes total sense. Capturing the economic reality, not just the legal paperwork. Okay, so let's break down these two big entries then.
Yeah.
The lease liability and the right-of-use asset. Let's tackle them one by one. Where should we start? Maybe with the liability. How do we figure out that initial number? Okay, so we've established this. Lease liability needs to go on the balance sheet right at the start. But putting an actual dollar figure or pound figure on that liability, that seems like it could be tricky. How do we calculate its initial measurement?
Right. The starting point for the lease liability is its initial measurement. And that is calculated as the present value of the lease payments that have not yet been paid at the lease commencement date.
Okay, present value. That's a term we hear a lot in finance. For some listeners, maybe it sounds a little intimidating, or perhaps they've heard it but aren't totally sure what it means right here for a lease liability. Can you break that down a bit?
Absolutely. It's a fundamental concept, but we can definitely demystify it. In simple terms, present value here means we take all those future cash payments that the company is contractually obliged to make.
Like the monthly installments.
Exactly. The regular monthly, quarterly, whatever installments. Plus maybe other amounts like the price they'd pay if they exercise a purchase option at the end, if the SMT is reasonably certain they're actually going to do that.
Okay.
We take all those future outflows and we discount them back to figure out what they're worth in today's money right at the start of the lease.
Why do we do that? Why not just add up all the future payments?
Because of the time value of money. $1 today is worth more than $1 promised next year or 5 years from now. There's inflation, there's the opportunity cost. You could invest that dollar today and earn a return. So we use a discount rate, basically an interest rate reflecting that time value and the risk involved to calculate the equivalent value of all those future payments in today's terms. It's about recognizing the true economic burden of that future commitment right now.
Got it. Discounting future cash flows back to today's value.
Yeah.
Now, here's something that really jumped out at me from the source material, and it feels crucial. It says we have to make sure you exclude any lease payments made on or before the commencement date. These like maybe a non-refundable deposit or if the first installment was paid right on day one. That kind of raises a question for me.
Yeah.
Why? Why exclude those initial payments? It seems a bit counterintuitive initially.
That's an excellent question. And honestly, getting this right is key to understanding what the lease liability actually represents. We exclude them precisely because the lease liability is all about your outstanding future obligations, what you still owe.
Okay.
If you've already paid a non-refundable deposit, or you paid that first installment on or right before the day the lease starts, well, that cash has already gone out the door. It's left your bank account. It's no longer a future commitment that you need a liability on your books for.
Okay. It's already settled.
Exactly.
Right.
It's simply a cash outflow that happened up front. Yes, it was necessary to get the right to use the asset, and we'll see it comes back when we look at the asset cost. But it's not part of the debt you still owe going forward. It's not something you're going to pay interest on. Think about it like making a down payment on a car loan.
Okay, yeah.
You hand over that initial cash, you get the keys. That down payment isn't part of the loan balance that you then make monthly payments on and accrue interest on.
Right. The loan is only for the remaining amount.
Precisely. It's the same idea here, those upfront lease payments. Vital for securing the deal, yes. But because they're already paid, they don't form part of the present value of your future financial commitment. That's the core idea behind the liability.
That car loan analogy really makes it click. It's only the remaining future payments that make up that initial liability figure we carry forward. Okay, so we've got the starting point pinned down. But a lease, obviously, isn't static. It runs over time. How does that liability figure change? How does it evolve over the life of the lease?
Right. Once you've got that initial lease liability on the balance sheet, it doesn't just sit there. It's a dynamic figure. Over the lease term, two key things happen constantly. First, the lessee incurs interest on the outstanding balance of that liability, and second, they make those regular installment payments we talked about.
Interest accrues and payments are made.
Exactly. And both of those activities have to be meticulously reflected in how we subsequently measure the liability, period after period, to make sure the number reported on the balance sheet stays accurate.
Okay, let's break that down. How does the interest part work first? How is it calculated, and where does it actually end up in the company's financial reports?
Okay, the interest. It's calculated using a constant periodic interest rate. That rate is usually baked into the lease agreement itself, or if not, there are rules for determining it. And it's applied to the outstanding lease liability balance at the beginning of each reporting period.
So interest on the opening balance for the period.
Correct. This calculated interest charge is then recognized in two places. First, it hits the statement of profit or loss as a finance cost. That's a debit entry, so it reduces the company's reported profit for that period.
I have profit impact.
And second, that same interest amount is added to the lease liability balance on the statement of financial position. That's a credit entry, effectively increasing the amount owed. So the liability grows over time due to this accrued interest.
Right, the debt increases before you pay it down. And then, when the company actually makes one of those regular installment payments, what's happening then? What's the effect of that cash going out?
Well, that installment payment serves a crucial dual purpose. When the cash goes out, it simultaneously reduces the principal amount of the lease liability chipping away at the debt, and it also covers the interest that has accrued up to that point.
So part principal, part interest.
Yeah, exactly, just like a standard loan repayment. Each payment covers the cost of borrowing the interest and pays down some of the actual debt.
Now, you stressed earlier that the timing of these payments, whether they're made in advance or in arrears, is absolutely critical. Can you walk us through that and maybe use the kind of logic shown in our source material, explaining how that seemingly small detail completely changes the calculation and how the liability looks at the year end? This feels like a really key point that could easily trip people up.
It absolutely is critical, and yes, it's one of the most important practical distinctions to get right for accurate reporting. Let's walk through two clear scenarios, maybe using a simple timeline to make the mechanics really obvious. Scenario 1. Payments in arrears. Let's imagine a lease starts right on January 1st, 2022, the beginning of the company's financial year. 1. First, you calculate the initial lease liability, that present value of all the future lease payments starting from that date. Let's say you get a starting balance. 2. Okay, now, throughout the whole year, from January 1st right through to December 31st, 2022, interest is building up on that liability. So you calculate the finance cost for the year. That's the annual interest rate multiplied by the starting balance on Jan 1st. You then add this finance cost to the liability balance, the debt grows. 3, then right at the end of the year, say on December 31st, 2022, the company makes its first installment payment because it's paid in arrears, meaning at the end of the period it covers. So you subtract that payment from the now increased liability balance. 4, the figure you're left with. That's your closing lease liability, the amount carried down CD at December 31st, 2022. And that becomes the opening balance for the next year, 2023.
Okay, so the cycle is start balance, add interest for the year, then subtract the year-end payment.
Precisely, and that cycle repeats. For 2023, you calculate the finance cost based on the opening balance on Jan 1st, 2023, which was the closing balance from December 31st, 2022, add that interest, and then subtract the second installment payment made on December 31st, 2023. It's a very predictable pattern. Interest accrues on the outstanding balance, increasing the debt, then the payment comes in at the end to cover the interest and reduce the principal. ready for the next cycle. Very much like a typical mortgage payment schedule.
That's super clear for arrears. Interest first, then payment. So how does it flip if the payments are made in advance?
Scenario 2. Payments in advance. Let's use the same start date, January 1st, 2022. 1. Again, you start by calculating the present value of future lease payments. However, and this is crucial, you immediately exclude installment 1 from this calculation. Why? Because that first payment was made right on the commencement date, January 1st. Remember our earlier point. Payments made on or before commencement aren't part of the future liability, so your starting liability figure is lower than in the arrears case. 2. Okay, now, throughout the year 2022, you calculate the finance cost, but this time the interest is calculated on the balance after that first installment was already paid. So you're calculating interest on a smaller opening balance. You then add this finance cost to the liability. 3. The resulting balance at December 31st, 2022 is your closing liability carried down. Notice there's no payment subtracted at year end here. 4. Now think about the start of the next year, January 1st, 2023. Installment 2 is paid in advance on this date, so it immediately reduces the liability balance before you even start calculating the finance cost for the year 2023.
So the payment comes before the interest for that period starts accruing. The order is completely reversed compared to arrears.
Exactly. The payment reduces the principal first, and then interest accrues on that lower balance throughout the year.
Wow. Okay, that breakdown is brilliant. It's like financial choreography, isn't it? Getting the timing of those interest charges and payments exactly right. It really hits home why messing up that advance versus arrears distinction could lead to some pretty awkward year-end discussions, maybe with the auditors.
You could definitely say that. Getting the timing right is fundamental to faithfully representing the financial position. Now, once we have that total closing liability balance at the year end, how does it actually get shown on the balance sheet? Because that presentation is what investors and lenders are going to see.
Good point. That total year-end liability figure then needs to be carefully split. It gets divided into its current portion and its non-current portion for presentation on the statement of financial position.
Current versus non-current. What's the difference there? The current portion is the amount of the principal repayment that's expected to be made within the next 12 months from the balance sheet date. The non-current portion is everything else the principal due beyond that 12-month window.
Okay.
Typically, you'd calculate the non-current part first, often by doing the present value calculation for payments beyond 1 year, and then derive the current liability by subtracting the non-current amount from the total closing liability. This split is absolutely critical for anyone reading the financial statements. Investors, lenders, analysts, they need to see a company's short-term obligations versus its long-term debts to properly assess its liquidity and solvency. It's a key indicator of financial health.
This incredibly detailed look really shows just how dynamic that lease liability is. It's constantly moving, shifting with interest and payments, and it just hammers home how vital that timing element is for accurate reporting. It literally shows how a company's reported debt level changes just because of these lease deals, which, as we said earlier, is a massive deal for anyone trying to judge a company's financial health and risk. Okay, now that we've thoroughly wrestled with the liability side, the what they owe, let's flip over and look at the asset side. What they gain the right to use, that right of use asset. All right, so on one side of the balance sheet, we've got the liability representing all those future payments. And on the other side, we have the corresponding asset, the actual right of use the company has acquired. How do we figure out the initial value, the initial cost of that asset? Surely can't just be the same number as the liability, can it? There must be more to it.
That's a very sharp observation. You're right. The right of use asset is initially measured at its cost. But that cost isn't just a mirror image of the initial lease liability. It's designed to be a much more comprehensive figure. It aims to capture the full economic outlay the company made to get that right of use and have the asset ready for its intended purpose.
Okay, so it's broader than just the present value of the payments. What other components get bundled into this cost of the right of use asset? Sounds like there are a few moving parts.
There are. It's basically a combination of several key factors. Let's list them out. First, yes, you start with the initial measurement of the lease liability, that present value of future payments we spent time calculating. That's usually the biggest piece. Second, you add back any lease payments made on or before the commencement date. Remember those upfront deposits or advance installments we explicitly excluded from the liability?
They reappear here.
Exactly. They come back into the calculation here on the asset side. Why? Because they represent a real upfront cash cost incurred to secure that right to use the asset. It was part of the investment to get it. Third, you add any initial direct costs incurred by the lessee. These are costs that wouldn't have been incurred if the lease hadn't been entered into. Think things like commissions paid to arrange the lease, maybe legal fees specifically for drafting and negotiating it, perhaps costs to prepare the site or the asset itself for use.
Costs directly tied to getting the lease operational.
Precisely. Fourth, and this is an interesting one, you include the estimated costs of dismantling and removing the asset or restoring the site where it's located, but only if the company has a present obligation to do so at the end of the lease term. This falls under another accounting standard, IAS 37 on provisions. If they're already committed to these future cleanup costs, the estimated present value of those costs gets capitalized into the asset's cost now. It's seen as an unavoidable cost of using the asset.
Wow. Okay. Future costs pulled into today's asset value.
Correct, if the obligation exists at commencement. And then finally, one deduction. You subtract any lease incentives received from the lessor. This could be things like the lessor giving some cash back, offering a rent-free period up front, or contributing towards fit-out costs. These incentives effectively reduce the lessee's overall economic cost of getting the asset ready, so they reduce the capitalized cost of the right-of-use asset.
Okay, that is definitely much more comprehensive than just the liability figure. It really tries to capture the total economic investment the company made just to get that right of use operational. Can you maybe give us a quick, practical business example to make that whole package of costs feel a bit more tangible?
Sure, let's go back to a business setting up a new office space via a lease. The lease liability is like the present value of all their future rent payments. But the initial cost of their right-of-use asset would also include that potentially large security deposit they paid up front, payment on or before commencement, maybe the estimated cost of removing the fancy partitions and specialized wiring they installed, which they contractually have to rip out at the end, dismantling costs, perhaps the legal fees they paid their lawyer to review the lease agreement, initial direct costs, and maybe the landlord gave them the first 3 months rent-free as an incentive. That incentive would be deducted from the asset cost. See how all those different pieces combine.
Yeah, that really brings it together. It's all the bits and pieces needed to make that leased office usable from day one, adjusted for any help from the landlord. Okay, so once we've meticulously calculated this initial comprehensive cost for the right-of-use asset, how do we then account for it over time as the company uses it? And crucially, how does it actually get presented on the financial statements for outsiders to see?
Okay, so once that right-of-use asset is on the books at its initial cost, what happens next? Well, subsequently, it's typically measured using the cost model. That's very similar to how companies account for their owned property, plant, and equipment under the standard IAS 16.
Cost model, so cost less accumulated depreciation.
Exactly. Cost less accumulated depreciation and any impairment losses. Now, it is technically possible to use the revaluation model if the underlying asset is the type of asset the company usually revalues, like maybe certain properties, and if they apply that policy consistently. But the cost model is far more common in practice for right-of-use assets. And yes, the key thing is, just like any other long-term asset that provides benefits over time, the right-of-use asset must be systematically depreciated.
Depreciation makes total sense. The value or the economic benefit of that right to use is being consumed over time. But there's a really crucial rule here about the period over which you depreciate it, isn't there? It's not always straightforward, like the asset's physical lifespan.
You're right. There is a very important rule, and it really goes to the heart of faithful representation for leases. Depreciation starts from the lease commencement date, obviously, but it's recognized over the shorter of the useful life of the underlying asset and the lease term.
The shorter of the two. That's really interesting. Why? Why the shorter period? I mean, if an asset physically seems like it could last for, say, 6 years, but the lease is only for 4, why do we only depreciate over the 4 years? This feels like a real aha moment for understanding the economic logic here.
It really is a key insight. The reason is all about reflecting the economic reality from the lessee's point of view. Remember, they don't own the asset legally. Even if the SMT knows that underlying asset, maybe a machine, has an inherent physical useful life of 6 years, if their lease term, their contractual right to use that machine is only 4 years, then that entity, that specific company, is only going to generate economic benefits from its right-of-use asset for 4 years.
Ah, they only control the benefits for the lease term.
Precisely. They don't get to use it beyond the lease term unless they renew or purchase it, which is a separate consideration. So the depreciation charge has to be matched to the period over which that entity actually expects to derive economic benefits from the asset under its control via the lease, not necessarily its inherent physical life. It paints a much truer picture of how the asset's value is consumed by that lessee during its limited period of use.
Okay, that makes perfect sense now.
Okay.
It's tied directly to the period the company actually benefits from it under the lease contract. Let's use that delivery van example again. A company leases a van for 3 years. The van itself might be good for 6 or 7 years, easily.
Right. But their right to use it, gained through the lease, only lasts for 3 years. So they depreciate their right of use asset over those 3 years, reflecting the consumption of the benefit they control.
Got it. Now, turning to presentation, how does this right of use asset actually appear on the balance sheet? Is it just mixed in with all the assets the company owns outright, like buildings or machinery they bought? Or is there something specific about how it's shown? So what does this mean for someone just casually looking at the financial statements?
No, it's not just lumped in, and this is another absolutely critical point for transparency and for anyone trying to properly analyze the company. Right of use assets must be presented under non-current assets, but they have to be shown separately from the company's owned property, plant, and equipment, PPE.
Separately, so like its own line item on the balance sheet.
Exactly. Either as its own line item, clearly labeled something like right of use assets, or disclosed separately in the notes to the financial statements, detailing which line items on the balance sheet include right of use assets. But the key is differentiation from owned PPE.
And why? Why is that separation considered so incredibly vital? Why not just group it with other non-current assets the company uses? After all, they're using it long term.
The separation is vital for users think investors, lenders, potential creditors, analysts. It explicitly signals that these assets, while controlled and providing economic benefits to the company, are not legally owned by the entity.
Okay. And the implication of that is?
The huge implication is this. If the worst happens, the company gets into serious financial trouble, maybe even faces bankruptcy, and can't continue operating these specific right-of-use assets, cannot be sold off by the company or its administrators to pay back creditors. Why? Because the legal title, the ownership, still rests with the lessor, the company they leased it from.
Ah, so they aren't available as collateral to cover the company's general debts in a liquidation scenario.
Precisely. So this separate presentation provides absolutely critical transparency about a company's actual asset base that could be used to satisfy creditors. It gives a much clearer picture of the company's true collateral strength and its ability to cover its debts if things go south. It's a really powerful piece of information about the underlying security structure of the business.
That distinct presentation, then, gives a much more accurate view of a company's real asset base and its capacity to maybe secure more debt or repay its existing creditors. That is invaluable information for anyone assessing risk. This constant theme, this distinction between the legal form of the contract and the underlying economic substance, it seems to be the thread running through this entire modern approach to lease accounting. Okay, so we've really gotten into the weeds, meticulously walking through how to recognize and measure both the lease liabilities and the right-of-use assets. It's quite detailed. But stepping back a bit, looking at the bigger picture, what major overarching accounting principle does this whole framework for leases perfectly illustrate?
Yeah, stepping back is important, and leases are just a superb, almost textbook example of a really core accounting principle in action, the principle of faithful representation.
Faithful representation. That sounds important.
It is. The conceptual framework for financial reporting, which is like the Constitution for accounting standards, it mandates that financial information isn't just useful if it's relevant. It also has to faithfully represent the substance of the economic events and transactions it claims to represent.
Okay, so connecting that big idea, that philosophy of accounting, specifically to leases, how does the lease accounting standard ensure this faithful representation? What does it mean in this context?
Well, that means looking beyond the strict legal form. Legally, as we've said, the lessee doesn't own the asset. But economically, they've gained a really significant and valuable right to use that asset, and they often control its use and get the vast majority of its economic benefits for a substantial chunk of its life.
Right. The economic reality is different from the legal title.
Exactly. So if we were to just treat lease payments like simple rent expense period by period and keep the asset and the long-term payment obligation completely off the balance sheet, well, that would fundamentally fail to faithfully represent the true economic reality.
Because the company really does have a long-term asset it controls and a long-term liability it owes.
Precisely. And historically, before the current standard IFRS 16 came in, many companies used what were called operating leases, specifically to keep these significant assets and liabilities off their balance sheets. It arguably masked the true extent of their financial leverage and commitments.
So IFRS 16 was designed to fix that.
Largely, yes. It was introduced precisely to close that loophole, to force companies to reflect the economic substance of these long-term lease arrangements on their balance sheet. So leasing is the perfect illustration of why this principle of substance over form is so critical. It ensures the financial statements tell the true economic story, the underlying reality, not just what the legal contract says on the surface.
So it's not just about following rules blindly.
Not at all. It's about getting to the truth behind the numbers. And that's absolutely crucial if those numbers are going to be useful for making genuinely informed decisions.
The truth behind the numbers, love that. Now, let's shift gears just slightly. This whole topic, it's not just for the technical accountants sitting in the back room crunching the numbers, is it? How does all this lease accounting stuff filter up? How does it factor into the big strategic decisions made by a company's senior leadership? What's the view from the boardroom?
That's a really crucial point. And it's why understanding leases goes way beyond just the accounting department. While we've been digging into the specific calculation rules and recognition criteria, the source material also highlights that leases are often examined in much broader strategic contexts, like in case study exams focusing on operational decisions.
Okay.
And in those kinds of scenarios, the main focus usually isn't on doing the complex present value calculations yourself. It's much more about being able to explain the underlying principles, what a lease actually is, how it's initially measured, how it changes over time, and most importantly, understanding the profound impact on the company's financial statements when the senior management team decides to enter into a lease contract versus, say, buying outright.
So it's less about the how-to of the calculation and more about the so what. What are the consequences of this decision for the business as a whole?
Exactly. It's about understanding those cascading, broader consequences. How does the decision to lease ultimately shape the company's entire financial narrative that it presents to the outside world?
Right.
This really underscores that understanding leases isn't just for accountants, it's actually a core competency for anyone involved in or aspiring to business leadership. The SMT needs to fully grasp the strategic implications. How does choosing to lease versus buy affect our balance sheet? How does it impact our reported profitability through finance costs and depreciation? What does it do to our overall financial health metrics, our leverage ratios like debt to equity? How does it affect our operational flexibility?
And all of those things directly influence.
They directly influence how investors see the company, how credit rating agencies assess it, how easily and cheaply it can borrow money in the future, and ultimately how agile and competitive it can be in its market.
I can just picture that SMT meeting now. They're debating getting a whole new fleet of, I don't know, high-tech delivery vehicles. Buy or lease.
Yeah.
Their decision is going to massively swing their reported debt levels, their return on assets ratios, maybe their earnings per share, all those critical numbers that investors scrutinize. Leasing might free up a ton of capital right now, letting them pour money into vital R&D, maybe speed up product development, grab a competitive advantage.
Or give them crucial agility to scale up or down quickly if the market's volatile without being tied down by owning all those assets.
Right. But then again, maybe owning them outright offers better long-term value in a stable market, or more control over modifying the vehicles.
Yeah.
But that comes at the cost of hitting their liquidity now and loading up the balance sheet. It's not just accounting, is it? It's a fundamental strategic chess move.
Absolutely. It influences everything from investor confidence to day-to-day operational flexibility. It really shapes the company's path forward.
Indeed. And that actually leads us neatly into another really fascinating strategic angle that SMTs definitely consider. Sometimes, for various strategic reasons, management might actually prefer to avoid recognizing a full lease liability and the corresponding right-of-use asset on their main balance sheet.
Avoid putting it on the balance sheet. Even with IFRS 16 trying to bring everything on, how can they do that?
Well, this is where IFRS 16, while pushing hard for transparency, also includes specific optional recognition exemptions for certain limited types of leases.
Exemptions. Okay. So there are still legitimate standards compliant ways to effectively keep certain leases off the books, at least from a balance sheet perspective. What are these exemptions? What qualifies? Yes, there are two main ones, and they are optional. Companies can choose to use them or not. One, first, there are short-term leases. These are defined as leases that, at the commencement date, have a lease term of 12 months or less. Importantly, this also includes considering any options to extend if there's a purchase option the lessee is reasonably certain to exercise, it wouldn't qualify. 2. Second, there are leases of low-value assets. This is assessed based on the value of the underlying asset when it's new, regardless of whether the leased asset itself is new or used. The standard doesn't set a hard number, but the guidance suggests a threshold around, say, US $5,000 or less.
$5,000 when new. What kind of assets are we talking about there?
Think personal computers, tablets, maybe standard office furniture, small telephone systems, things like that. Definitely not cars or significant machinery or property.
Okay, so if a lease qualifies as short-term or low value and the company chooses to apply the exemption, what happens then? How are the payments treated?
If the entity elects to use one of these exemptions, then they simply do not recognize a right-of-use asset or a lease liability on their balance sheet for that specific lease. Instead, the lease payments are just recognized as an expense, typically on a straight-line basis over the lease term, directly in the statement of profit or loss.
So it goes back to looking more like a simple rental expense.
Essentially, yes. It's very similar to the old accounting treatment for what used to be called operating leases before IFRS 16 came along.
Okay, that is a really significant difference in reporting compared to the main model we've been discussing, which brings up a massive question for our listeners. Why? Why might an SMT deliberately want to avoid recognizing a lease liability on their balance sheet, even if it's perfectly allowed under these exemptions? What's the strategic game being played there? What outcome are they aiming for?
That's the million-dollar question, isn't it? The strategic play isn't just about tidying up the accounts for small stuff. It can be about actively managing the company's perceived financial health and its key performance indicators.
Oh, so.
Well, think about it. If you keep liabilities off your balance sheet, what does that do to your financial ratios? Your reported debt levels look lower. Your leverage ratios, like debt to equity, look better, potentially much better. Your return on assets might look higher because you have fewer assets recorded on the balance sheet generating the same profit.
So it can make the company appear financially stronger, less risky?
Potentially, yes. It can make the company look less leveraged, more financially robust. And that can be really advantageous if you're, say, trying to attract new investors, maybe planning an IPO, or negotiating with banks for loans where they might impose strict debt covenants, limits on how much debt you can carry relative to your equity.
So using these exemptions becomes a tool to present a more favorable financial picture.
It can be used that way, yes, within the rules, of course. It allows companies some flexibility in how their financial position is presented. It shows how accounting standards, even when aiming for transparency like IFRS 16, can still offer pathways for companies to strategically manage their financial narrative.
That's a really powerful and quite nuanced insight. It shows how companies operate within the boundaries of the rules to manage how they look. It's also a stark reminder, isn't it, that even when financial statements are fully compliant with accounting standards, they still require careful, critical reading and interpretation.
Absolutely.
It's not just about looking at the numbers in the reports, but also thinking about what choices might have been made, what might have been excluded from the main statements through elections like these exemptions. So what does all of this mean for you, the learner, the analyst, the future business leader, as you navigate this complex financial world? #tag outro.
Wow, what an absolutely fascinating deep dive today. We really covered some ground. We started with that relatable feeling of buying a home and scaled it up to the huge strategic decision businesses face, to lease or not to lease.
Then we drilled down into the precise definition of a lease, the nuts and bolts of recognizing and measuring those lease liabilities, and the all-important right-of-use assets. We really got into the weeds on payment timing advance versus arrears and all the components that make up the asset's cost.
We did. Lots of detail there.
And finally, we stepped back to look at the bigger picture, how this all ties into faithful representation, how it impacts strategic choices for the SMT, and even how companies can sometimes strategically navigate the rules using those recognition exemptions.
Indeed. And I think what's really vital for you, the listener, to take away from all this isn't just memorizing the calculation steps, though. Obviously, understanding them is important, especially if you're in accounting or finance. But it's really about grasping the underlying economic reality that these complex accounting rules are trying to capture. It's about seeing how businesses finance their operations, how they manage significant risks like obsolescence, how they position themselves for innovation and growth, and crucially, how their true financial position and commitments are reflected or sometimes sometimes perhaps subtly managed in their financial reports.
That understanding is just invaluable, isn't it? Whether you're evaluating a company for investment, working within one, or aiming for a leadership position yourself.
Couldn't agree more.
Absolutely. So let's leave you with a final thought-provoking question to chew on. Something to apply as you look at companies in the real world. When a company makes that conscious choice to use those IFRS 16 exemptions for its short-term or low-value leases, effectively keeping potentially numerous, albeit smaller, financial commitments off its main balance sheet, how might that decision, perfectly compliant, remember, how might it subtly, or maybe not so subtly, influence an investor's or a creditor's perception of that company's true financial risk, its overall stability?
Good question.
And perhaps more importantly, what level of vigilance, what kind of deeper questioning and analysis does that demand from you as a diligent user of financial statements to ensure you're really seeing the complete picture of the business's underlying economic commitment?
Something to definitely think about.
Keep asking those sharp questions. Keep digging beneath the surface of the numbers, and keep applying these insights to the incredibly dynamic financial world all around us. Thanks so much for joining us on this deep dive.
Thanks, everyone.
We'll catch you next time.